Hello and welcome to our latest Insider interview. I'm Kyle Caldwell, and today I have with me Guy Anderson, who is fund manager of the Mercantile Investment Trust. Guy, thanks for coming in today.
Thank you for having me.
So, Guy, for a long time now, the UK market has been unloved. Both funds and investment trusts have been out of favour with investors pretty much since the Brexit vote. So, what needs to happen for sentiment to turn more positive?
That is a very good question. And as you know, we have seen that clear flow of outflows since the Brexit vote. And I think it's not unreasonable to suggest that Brexit, whether it was a good thing or a bad thing, injected a lot of uncertainty into the UK. And one thing we know is markets don't like uncertainty. And we've had a number of fluctuations since then. We've had periods where things were starting to look a bit better for the UK, and then of course we've had to manage the pandemic and the Russian invasion of Ukraine, etc., etc. I think what we think looking forwards anyway is that if we are entering a period of greater stability, that can allow the underlying strong fundamentals of the businesses in which we're investing and other investors in the UK are investing to shine through. And that will hopefully present a better playing field and therefore attract more investors back into the UK. Of course, alongside this, we have to think about the potential changes that are coming as a result of change in government in the UK, et cetera, et cetera. And of course, we're on a bit of a watching brief on that front at this point.
We're towards the end of the year, so I'm going to ask you an outlook question. For 2025, could you name your top reason to be optimistic for the UK market? And could you also name a reason for investors to be fearful?
Sure. So for me, actually, it always comes down to the individual stock opportunities that we're seeing in the portfolio. And in aggregate, we are currently finding more companies that we want to buy into the portfolio than those that we want to sell. And I think that is often the single best indicator that things are improving rather than deteriorating. I could, of course, step back and say from a top-down perspective, why should we be positive? And the reasons I think are fairly simple. It's that the UK is actually going through an economic upgrade cycle. We've had positive surprises to GDP growth, and yet that is not reflected in the valuation of the UK market, which is clearly trading at a substantial discount to many international markets. And in particular, mid and small caps, the part of the market in which I'm investing, those are more domestic and more economically cyclical. So if the outlook there is improving, that should have a better impact on those companies than the overall market.
And what would you say in terms of a negative for the UK market? Is one possible reason in terms of fund flows that investors just continue to go into global and US index funds due to the fact that 7 technology companies are performing so strongly as a collective?
I do think it's very difficult for investors to fight the tide. And if we can see one market that's consistently doing well, it's quite difficult to sell those holdings. Psychologically, it's quite difficult to sell that and then buy something that hasn't done as well. But I think what we can see is if we have a period of greater stability in the UK, hopefully that can allow the positives of the UK to shine. And therefore, really, you only need a small delta in perception to generate a big change in the outlook. One of the benefits of running Mercantile, of course, is we have that permanent capital. And so whilst it's really challenging to manage a strategy when there are lots of flows going in and out, for us at least, we can take genuine long-term investment decisions, knowing that we're not going to have to sell an investment tomorrow just because of an outflow.
We've, of course, had the general election in the UK a couple of months ago. One sector I've seen some fund managers talk up is UK housebuilders, due to the fact that the Labour Party are committed to increasing the supply of new houses. Is this an area of focus at all?
So it is for us. So actually, house builders as a subsector is the second largest overweight in the portfolio. It represents about 4% in terms of the overweight. That is an area that actually we increased last year, so in the summer of 2023 rather than 2024, at a point where there were obviously quite a lot of fears about the outlook for house prices, and interest rates were on the march up. And that was a great opportunity for us because we were able to add to our pre-existing position in Bellway, for example, at a near 40% discount to its net asset value. So we thought that was a brilliant opportunity, and as a result, added quite substantially to our holding there. When we think about the Labour policy, for this economic cycle, they obviously have the target to build 1.5 million homes during this parliament, so 300,000 homes a year. That is roughly on an annual basis 10% higher than we achieved in the previous peak back in sort of 2019-ish. So that is quite a material step up. And also, if we think about the current run rate of annual production of houses in the UK this year, which is probably the nadir in the cycle, we're probably, as a nation, building around 180,000 homes. So that is a massive uplift from here. I don't think we've yet seen any actual improvements on the ground. But the rhetoric from the Labour Party is clearly that they want to free up the supply side so that this can happen. We will watch and observe what they do rather than what they say in terms of facilitating that. But I think for the house builders to be an interesting opportunity, we don't need to get up to that 300,000 level. We just need to see the cycle recover and hopefully move back at least towards that sort of 250, 260 level that we've seen before.
In terms of sectors, consumer discretionary is your top sector allocation. Mm-hmm. Could you explain why and provide some stock examples?
Sure, of course. So, of course, the portfolio is built on bottom-up stock selection, so it's very much about the individual opportunities that we find. But when we look from the top down, we do see an improving landscape for the domestic consumer-facing stocks. So we're in an economy in the UK where we've had now real wage growth for over 18 months. We've got improving consumer confidence, notwithstanding the recent setback around the budget, but we have generally improving consumer confidence. So the top level thesis is that we have the average consumer that both has more money available to spend and has higher propensity to spend, and so that should lead to an improvement in consumption. So I think that's a reasonably favourable backdrop. When we look at the individual companies that we hold a number of stocks where those companies' prospects get better based on an improving macro, but where ultimately a lot of their growth is driven by internal actions and market share gains. So the investment theses are not dependent upon that positive macro environment. So the largest example would be our holding in Dunelm, which is the homewares retailer, which has really grown tremendously over the last 40 plus years now, and that has been a case of gradual market share gains, taking share from some of the incumbents who have generally, many of which have had some structural problems. So if we think about department stores as an obvious example, and Dunelm continuing to take market share gains, and we see a further runway for that to continue. To put it in context, I think it's something like 90% of their growth over the last 10 years has been because of market share gains and only 10% because of the market growth. So I think that's a great example. We've also got a pretty substantial investment in WH Smiths. So WH Smiths, many people will think of as a high street retailer in the UK. The reality is it's really a travel retailer. One of the positives about travel retail is you have effectively a sort of a closed consumer or target consumer, so you have better economics because you have better pricing within a travel hub, and that's the part of the business that they have been growing over time and generating pretty nice returns from.
Investment trusts have the ability to gear or borrow to invest. Due to the fact that you're finding lots of opportunities in UK mid caps and UK small caps, have you been increasing gearing levels?
Yes, we have. So Mercantile has the ability to go from 10% net cash to 20% geared. That's the sort of wider range that we could operate in. Where we're sitting today, we're 15% geared, which is almost the highest we have been over the last 12 years or so, the highest being around 16%, which we reached actually earlier this year. So gearing is clearly elevated. And one of the things that I tend to say is it's more interesting, hopefully, to observe what we do versus what we say. And clearly, running with that level of elevated gearing must demonstrate the conviction that we have in the portfolio today.
And finally, a question we ask all fund managers: do you have skin in the game?
Yes, absolutely. So, barring the family home, my investment, as well as my wife's investment and my children's investment in Mercantile is by far our largest financial asset.
That's great to hear, Guy, and thank you very much for your time.
Great. Thank you, Carl.
That's it for our latest episode of our Insider Interview series. Let us know what you think. You can comment, like, and do hit that subscribe button for more videos. And I'll see you again next time.